On today's episode of the Modern Lending Academy, I really wanted to focus specifically on something that I've been getting a ton of requests and questions on with everything that's happening in the real estate market. Obviously, what we're seeing right now is with continued interest rates being at insanely low rates, combined with the fact that you have a population shift, whether that is people moving out of condos and into single family homes that they want to just rent, or it's for investors kind of taking some money out of the stock market and looking to put it into additional asset classes like real estate and investment properties. I thought there was no more perfect way to start than to really break things down onto what I call investment property 101. So many people come to me and they say, "Hey Brian, I want to buy an investment property. Where should I buy?" Well, okay, that's like somebody coming to me and saying, "Hey Brian, I like to drive. What car should I buy?" Well, you got to tell me, like, do you need it for work? Are you commuting? Do you need to pull a boat with it? How far do you live, right? There's all these other variables. And that's why it's laughable to me when I have somebody just says, "I want to buy an investment property. Brian, where should I buy?" So rather than sitting there and kind of, making it this, oh, make sure you have a good price to rent ratio and this and that and everything go over everybody's head, I wanted to start at what my mentor started me on and understanding what is the end game. Because once you know what the end game is, then you know what property type to buy and the value investing you're going with. And then I can go into further how to target particular markets for these items, what different metrics you want to look at. But before we even get into it, we need to understand what the end goal is, right? If your end goal of buying a car is, hey, I need to commute from Temecula to San Diego. Well, you know what? I'm going to find the best gas mileage vehicle and recommend that for that particular individual. Now, if somebody else they got to pull a big boat or a fifth wheel because they travel using that all the time. Well, in that case, what do I want to do? I want to make sure I'm, suggesting them a big heavy duty truck, a dually or a Dodge Ram or something like that, right? So let's figure out and understand what the end game is. And there's two real end games. And yeah, there's maybe some overlapping, but at the end of the day, when you're thinking about investing in an investment property, what is your end goal? And really at the end of the day, it's this. Are you looking at putting a sum of money into a property and you don't really care if that rent coming in covers the mortgage because your goal is to take that money and generate the highest return on investment when you sell that property someday, right? You want to buy a property and put a certain amount in, and then 7-10 years down the road, you want to sell that property and you want to have a fat return, okay? Or is your goal the fact of hey, I want to invest some money into a property and I need to generate immediate cash flow. I can't be running a negative monthly because one, my current job doesn't give me the ability to have an extra income to cover that mortgage to rent difference. Or my goal is I want financial freedom. I want to quit my job. And so I need that passive income that's being generated from all these rental properties to supplement my job because my goal is to leave work early and I just want to do that, right? So do I want to invest and don't really care if I make a bunch of money per month? I just want to turn that money into the biggest sum when I sell in the future. Or I need to basically make as much money monthly as I can for every dollar I have invested to be able to do that, right? And what's important about understanding that is you're never going to get the best of both worlds. And the reason for that is, for an example, areas that have typically much higher appreciation, okay, are going to have typically areas that have a very high amount of demand for a very low supply of homes. And what could cause that would be maybe, let's say you have something of an intangible, right? A coastal community or a particular community that's very close to a major metro area. Like, for example, Amazon moving one of their big headquarters to Nashville. So in that immediate area around Nashville, there's gonna be a very high demand for a lot of executive homes. And there's not only so much supply in that geographic area without having to commute in. Or you want to be living on the beach and have beach views, or you want to be living around a lake. And so there's those kind of intangibles that are typically geographically located, right? Now, and when that happens, what happens? Those prices go up, and a lot of times the cost for that home compared to what maybe that rent would be paid on it is a big discrepancy, right? So you're foregoing the kind of immediate gratification of covering your mortgage with the rent for the long-term goal of I'm going to watch my my house price skyrocket over the course of time. And when I sell, I'm going to make a big sum of money, right? Because what happens typically in areas where you have a pretty high rent to the actual price of the home, meaning the amount of rental income that comes and generates to the price of that home, you're not going to typically see as great of appreciation values. You're typically in those kind of, microclimates aren't going to really see that. And that's just historically the way it's been for just a number of factors. A lot of times it could be the socioeconomics, that just not a lot of people there are constantly being able to buy homes, or the cost to construct these homes doesn't really have an intangible that goes with it. So like, for an example, the perfect example of a cash flow market is Montgomery, Alabama. Okay, so I've done all my research for everything. If you guys want, is using BP Insights. It's fantastic for data. It is a little expensive to, go ahead and sign up for this data, but this is where everything is directly coming from. And this is obviously as of the end of the third quarter of 2020, as we're filming this in October of 2020. So Montgomery, Alabama. So median house price in Montgomery, Alabama is approximately $100,000 right now. The appreciation that is planned is about 2% per year, meaning that house price is to go up about 2% per year. Now, the average median rent is $850 a month. So for those of us that are on the West Coast, it's crazy to even think you can buy a house for $100,000 and then let alone the rent's $850 a month. So we're obviously getting dollar signs in our mind just thinking about that, right? But that rent goes up about 2% per year, okay? Because there's a lot of supply in the market, so you can't have the same type of exponential increases to the rent because they have a lot of obvious, choices. I mean, if you jack their rent up by 5% per year, well, they're just going to go find somebody else who's only, keeping that rent stable and the same, okay? So now a mortgage, putting approximately 20% down and getting an investment property mortgage on something like this, including principal, interest, taxes, and insurance, is going to be roughly in the ballpark range, $400 to $475 a month, give or take. So let's use a median of about $430, right? So what do we see happen? We see, after we pay our mortgage every single month, roughly about $420 a month of positive cash flow. And remember, it only took us about 20 grand as a down payment. So you have some closing costs and little things, but we're going to kind of keep the closing cost aspect out of it, just so for very easy general numbers for everybody to follow along in this video. So we say, okay, $420 a month cash flow at the end of 7 years, right? So 84 months is going to generate about $35,000 of positive cash flow, okay? So every year, if I added up that total gross amount after I paid my mortgage, at the end of 7 years, I'm going to have about $35,000 in cash flow that's generated from me. It's pretty good, right? Put down 20,000 bucks, got back roughly $35,000. Now, you're going to see a value gain, meaning I bought my house at $100,000 and it's appreciating at about 2% per year. So at the end of that time, my house is worth, I've gained about $15,000 over what I've paid for it. So that gives me at the end of 7 years, my net worth per se went up by about $35,000 additional funds I put into my bank after I paid my mortgage. And then I got $15,000 more in equity in my home for my home appreciating. Now, you also have to factor in a couple different things. So one, you're going to need to make sure that you count for things called a vacancy, right? People, you may get lucky and the same tenant's in there for all 7 years, but the chances of that happening isn't super likely. You're going to have some tenant turnover, and there may be a month or 2 months every couple years that you could have some changing over of the tenants. You need to account for that. And then also too, on a home that is a lower priced home like this, well, you know what, if a water heater goes out, the percentage of that water heater's cost compared to the price of that home is a higher price than a water heater in a $500,000 home. At the end of the day, the water heater is roughly about the exact same cost, but the price of that home is much lower. So you're going to typically see a higher percentage of repairs costs to that home price, right? So at the end of 7 years, roughly, you figure your repairs costs and your vacancy is roughly about, call it about 15 grand. Say you have about $10,000 in repair costs over 7 years. Okay, roughly, about $1,500, $1,800 a year. And then you're going to have, call it five months or so of without having that rent come in of that $850 a month or whatever it was, depending on that slow appreciation in that rent. So at the end of it, $50,000 was obviously my cash flow I generated. $15,000 the equity gain in the home over 7 years. So I'm plus 50 grand, But outside my mortgage, taxes and insurance, I had about another roughly ballpark, about $2,000 a year or so in other costs. So I am net positive about $35,000 on the $20,000 initial investment I made at that down payment. So at the end of that year, we say, okay, well, 20 grand after I've generated 35,000 bucks, so I pay myself back the $20,000 that I originally invested, and I got a $15,000 profit. So I put in 20 grand after everything was paid myself back, I got 15,000 bucks. So over the course of those 7 years, my money went up about 75%. So for the course of 7 years, my money grew 75% from year 1 to the end of year 7. So pretty stinking good return, obviously, because there's some other factors of investment property, which for the sake of this video, I'm gonna leave out, like tax benefits of depreciating write-offs and all these other different things you can have. But just from a very easy to understand, we generated about a 75% return over the course of 7 years. So if you just very simply put that out, we were averaging about 10% or so per year in actual growth on our money. Now, that sounds good, right? Well, what are the pros and what are the cons? And why doesn't everybody just do this? Because it's a great, great, great investment strategy. And I've personally used this several times, and I'm actually kind of moving away from this right now, which we'll get into my next strategy here in a moment. But what are the pros and the cons? Well, obviously the pros are cash flow, right? You don't have to, if you're not making a bunch of money at your job, you don't have to really worry because the house pays for itself. The tenant is paying your mortgage off, right? Very, very simply put. Because mind you, after that mortgage of 7 years, obviously when I go to sell my home, I don't owe the $80,000 I borrowed, right? No, this tenant has paid down my mortgage. So kind of the intangible on that, of course, is they've paid down my mortgage loan on it. So not only did it completely cover itself, but now if I go to sell my house, I probably only owe about $70,000 on my house. So when I go to sell it, I'm also going to get back all the money for the difference between the payoff and what I sell it for, because that tenant went ahead and was in essence paying my mortgage of 430 bucks a month for all my taxes, all my insurance, and paid down my loan balance. So it's really, really nice from a cash flows perspective. Now, great thing is it's also cheap entry, right? On a cash flow property like this that are going to cash flow really well, which are typically lower priced homes, typically around $250,000 or less, it's a really low, cheap entry point in the market. It's great for initial investors to get in, because $100,000 to $200,000 property or $20,000 to $40,000 to gain entry point into doing this. And this strategy is what most initial investors use to get into that market because it is that very cheap entry point. Also, too, you have typically a low volatility. What that means is because this home and the rent is so inexpensive, you don't typically have a lot of people wanting to turn over that property, right? Because it's typically those rents are very low in the affordability index. So even if the market starts to dip a little bit, and as long as you're kind of picking the property in an area, where, there's not a dramatic too much supply of rental homes, you're not gonna have a big tenant turnover because it's cheap rent. There's not really any other places they can really go and get too much cheaper rent. So you have a low volatility of turning over. And the other great thing is passive income. As you can imagine, this was just after 7 years. So let's say you're going to go with this tenant. You have a tenant in this property, over the course of 30 years. You keep tenants in that property. At the end of 30 years, that house is paid off. Now you're over the appreciation of rent. You got whatever, $1,200 a month coming in, or whatever that appreciation of that rent is over that 30-year time. So it's a great way to have some nice passive income coming in on that property. Well, what are the cons? Well, the cons are obviously the expense repair, right? Because like we talked about, it's a cheap property. It's inexpensive in terms of that, but the repair cost compared to the actual entry point, you can think about it. Well, if it only took me 20 grand to get into that property, and let's just say, shoot, something comes in and there's a big flood in that house. Well, to replace the plumbing in a $100,000 house versus the plumbing in a $400,000 house, if they're both the same size square footage, it's gonna be a very similar kind of repairs cost. So those repairs expensive as a percentage of the price of that home are obviously higher. Also, too, you have a heavy dependency on occupancy. If you have a tenant that moves out and you've done this strategy because you don't have additional reserves to make that mortgage on your own, you're really dependent on making sure you always keep somebody in that property. So if you have, let's just say something really bad happened like a COVID and this renter isn't able to pay rent for 6 months, well, you know what? You're really dependent because you need that rent to pay that mortgage because that's typically why you've chosen the strategy. And then also too, management fees. Like obviously in this case, if you just have one property, you can do that. But you can imagine to generate a lot of passive income, you have to have a lot of properties. And it's not exactly an easy job if you want to try to manage a bunch of these individual properties. So you have to factor in management fees when you start getting a big portfolio of these items. So obviously there with a management fee, when they're managing a property, even if the rent is $850, you know, you typically, most management companies have a flat monthly, like kind of bottom line figure. You know, if your rent's $400 a month, they're not going to charge you $40, you know, to manage that. No, they're going to have a bottom line figure of $100 a month or $125 a month. And then typically you're going to have a lower economic tenant, typically in the lower price point home. So what can typically happen many times in that way is a lot of times if you don't pick the right area that has a very low income to rent ratio, meaning you want the rent to be a very low percentage of their overall income, you can really get into a position where you can have some high you know, delinquencies or defaults, depending on the socioeconomic area that you chose. And then lastly, like I mentioned, it takes a lot of properties if you're doing that cash flow standpoint to really see some big money coming in the door. You can imagine it's awesome, okay, but let's just say my goal is to make $20,000 a month in cash flow. You can do the math on how many properties, if I go under this method specifically, it's going to take me to get there. Now, obviously, this is just a low entry point example, but to really get some big money gains, I would have to own a lot of these particular properties. If my goal was, hey, you know what, I have $1 million I want to put into the market to really see some big gains, probably not going to go with just this strategy of buying, you know, paying cash for 10 investment properties at $100,000. You know, it's just going to be a lot of work to generate those returns with a lot of risk on that. I'm going to probably use most likely something closer to the other strategy I'm going to go in. So this is typically a great entry point. Now, cash flow, this strategy is what I used initially. When I originally got into the market, I went ahead and bought 5 rental properties outside of Dallas-Fort Worth. These rental properties are fantastic, and they did a great job for me. I picked them all up for about $200,000 to $220,000. They all were generating about $1,700, $1,800 a month in rent. The rents have gone up about 1% to 2% per year. The property values have gone up about 3% to 4% per year. And now here I am 5 years later, I'm selling those and moving the money into another market, which is why I'm doing this video. I'm kind of walking you guys through my journey, and there's going to have a couple parts to this series. And so, like I said, this was my entry point into the, you know, rental market right when I was in my early 30s, you know, when I started doing this. Now, cutting to the next strategy, like I said, is called the appreciation method. So you got your cash flow method, which is here, and then the next strategy we're going to look at is the appreciation method. Now, with the appreciation method, the science or the, you know, kind of the end game behind this is I'm going to take some money and I'm going to forego the immediate gratification of receiving some passive income every single month for the long game thing of, hey, let me put my money in this. I'll bleed money a little bit every month, with the end game being in 7 years or 10 years or whatever my investment end goal is. When I sell that property value will have gone up so much that even after I reimburse myself for the monthly losses, I end up with a much larger return on my investment than the cash flow strategy. Now, this strategy is typically employed by those that have a good high income earning job that they are willing to, at the end of the day, they want the investment strategy of being able to take some of the awesome tax write-offs that investment properties allow, between whether that is, you know, the depreciation write-off that you can do, your interest expense, a lot of things that investment properties do, but they're using it more as a store of wealth. They want to hedge against inflation, meaning, hey, I want to take my money. I don't want to worry about the stock market deteriorating it. I don't want to worry about having management fees or having, you know, my trader charging me 1% to 2% to 3% per year to manage my money. I want to take this money as a balanced approach to my overall wealth. I want to put it in the market and I want to let it sit there, and I'm okay to lose a little bit of money at the end of the month to kind of at the end of the day hit a home run when I sell that property, take that money and then roll it into a bigger asset. Whether that is it's a common strategy, and it's something that I'm actually going to be doing right now with a lot of my properties, moving from $200,000 to $300,000 homes and going ahead and buying some additional properties. Like I've just picked up a couple properties in Nashville at the beginning of the year, just picked up another property down in San Diego, and I'm looking at going ahead and now evaluating a couple other markets that we're going to kind of walk through together in subsequent videos. So let's walk through a fantastic market for the appreciation method is Denver, Colorado. So Denver, Colorado, over the last 3 years, from the year ending 2018, 2019, and the planning of 2020, has seen about an 8% annualized appreciation. Now, the forecasted appreciation over the next 7 years, both using BP Insights as well as using Black Knight data, is roughly at 6.7% on the median, which means I did not use the high-end number and I didn't use the ultra-low number. I used the median number, which is a safe conservative number to use, is 6.7% per year. Mind you, in Montgomery, Alabama, we just saw 2% per year, which means my house was at 100,000, was then worth 102,000, then it was 104.2 thousand, so forth and so on. So Denver, Colorado, now that price point right now, the median house price is $445,000 in this market. Why? It's a more expensive market to live in. Now, at $445,000 at 6.7%, my house appreciation is going to be pretty solid. It's going to be, just under $30,000 a year. Now, the rent is only $1,750 a month. So think about that. In Montgomery, Alabama, the median rent, so the rent to price ratio, $850 for rent compared to a $100,000 home. Look at that ratio, right? You're literally $850 a month times 12 months is roughly $10,000 a year. So the rent to the price is huge, right? So my rent compared to the price is massive. It's 10% if you annualize it, right? Well, look at this one. $1,750 a month, okay, over the course of 12 months is $2,000, okay? 20 grand. You're not even 0.5%, right? So it's a much lower, okay, rent to price ratio, okay? And that's very typical in high appreciation markets. You can imagine what some of the coastal communities or San Francisco or some of these other communities are at. So because, even if the cost of the house is really high, you're not justifying the rent. Nobody is going ahead and even buying a $3 million house and nobody's paying them $30,000 a month in rent. So even my house out in the wine country here is worth about $2 million. I'd maybe get $6,500 a month for rent. Compare that to what it would be, if I obviously had 20 properties in Montgomery, Alabama at $850 a month, right? I'm 3-4 times the amount of rent, that's generated. So the mortgage payment with 20% down on a 30-year fixed conventional loan with property taxes and insurance is roughly between about $2,100 and $2,200 a month, give or take. Okay, right now, which is lucky because rates are super low. So that means my mortgage payment is $2,130 a month, okay? So I am losing, as you guys can see there, right, just under $400 a month, about $380 a month of cash flow I'm using. Now, to get into that property, obviously, took a little bit of money, right? About $89,000. So 20% of $445,000, about 89 grand, right? So the last property was checked in Montgomery, my down payment was only 20 grand. Now it's 89 grand. It's a much, much higher entry point into it. That's why you typically don't start in this method unless, like I said, you're liquidating some of your money in stocks and moving something out there where you've been done well for yourself and you're now wanting to go ahead and pull some money out of your 401k to do this. So this is typically the level 2 of value investing into actually investment properties. Now, so the cash flow over the course of 7 years, I'm going to lose over $30,000. What does that mean? I'm going to have to cover the difference just between the mortgage and the rent I'm receiving of approximately $30,000 over that course of time. Now, the good news is my property value has been going up at 6.7% per year, not 2%. So I'm getting over 3 times the appreciation per year. Now, that $445,000 home is now maybe $260,000 in additional equity. So it has gone up in value. So my $89,000 that I put towards that grew to $260,000, right? Because my house value went up. So I, with $89,000, controlled an asset worth $445,000, and it grew in value by $260,000 to over 700 grand. So when I look at that and say, okay, my value went up by 260, but I had to spend 30 grand a month. My net 7-year gain is $230,000, right? Because I lost 30 grand, but now I'm getting 260 grand. So if I put that all in the same bank account, I'm negative 30 grand in the bank account, put that 260 in there, now I have a 230 balance, right? So vacancies and repairs. Now, typically speaking, obviously, with repairs, the water heater, those types of costs, doing, roughly in the ballpark area, I always like to say, typically speaking, you want to look at about, depending on the age of the property, 0.5% to 0.75% of the purchase price of the property every year for repairs, right? And then the vacancy on something like this, well, you think about it. The barrier to buy a home in that market, if I can rent the home for so much cheaper, typically people are going to stay in that home a little longer, right? Because they're like, shoot, there's always going to be that discrepancy in heavy appreciation markets. So like, shoot, that's why a lot of people rent in San Diego. They can rent the house for, for $2,500. To buy it was $3,500 a month, right? So there's a higher barrier of entry. It's a lower affordability index, a higher barrier to enter that market. So with vacancy, is going to be typically a little bit lower. You're not going to see many people moving as quickly. So about $38,000 in additional costs between losing rent, between tenants, and repairs over that time. So at the end of it, I'm talking about $191,000. You remember on the last one we looked at, it was about $35,000. So the last one, I took 20 grand and I turned it in to obviously about 35,000. Now here, I took 89 grand that I put in for my down payment. And after all this, I now have a net worth increase of 191,000. So the last thing we saw about a 75% return over the course of 7 years, right? About roughly, about 10% per year. Here, we saw 114% return, okay, right? So we saw a much, much heavier return, right? So we saw about a 50% better return on my money into this market. So this market, this appreciation method, is something that you can use both methods. Like I said, you can use the cash flow method and the appreciation methods to have a diversified portfolio, but you're gonna typically see your bigger return on your investments as a percentage in that appreciation market. But let's look at the pros and cons again, right? So what are the pros? Obviously, I just went into it. Higher return on investment typically. Lower vacancy, right? Because with a bigger discrepancy between the mortgage payment and the rent, I'm gonna have less turnover because there's not gonna be as many people going from a renter to a buyer as it is in a market where the mortgage is way lower than the rent, right? Like I mentioned, longer tenant. Now, there's gonna be less properties you need to earn your targeted return, right? So let's say I had $100,000 that I wanted to put in. Okay, I can buy 5 properties in Montgomery, Alabama on a down payment, let's just say, or I'm dealing with about 1 property here. So at the end of the day, you know what? My returns are going to be, depending on the way you do it, are going to be a little bit higher on this, and it has way less properties too. So that's way less properties I have to worry about having repairs on, or tenants moving out, or people to manage. So I'm able with a lot less properties to earn that targeted return. Conversely though, if I pick a bad market or I pick a bad property or I don't hit it right, obviously more of my eggs are in one basket than multiple properties, right? So there's a catch-22 to everything. The other con is there's more money up front. That last one only took me 20 grand into. This one is 89 grand for the down payment. So that's just for the down payment. So obviously you have closing costs and other things, but just to simplify this, I wanted to get both of those there. And then lastly, like I said, there's no cash flow. So, if you're only saving a couple $100s a month from your job to what your current expenses are, you better not be trying to do this method right off the bat. You better have a history of historically being able to spend a lot less money than you earn per month and have a certain savings set aside. So I tell somebody, if you're going to go into an appreciation method, you better have 6 months worth of emergency funds set away, and you better not be taking every last dollar you have and putting it into this method. Because you think about it, if we go through a COVID, let's say again, and hopefully there won't be that case, and you go 6 months randomly without rent on a property, and you just took all your money to get into this property, you're not in a good position, right? So that is one thing. So when you're kind of really looking at getting into that investment property, or better yet, as a real estate agent, you're trying to explain to your investor or your clients, because clients call, hey, you know what? I'm looking at going ahead and I want to buy an investment property. Okay, cool. Well, how much do you want to spend? Don't. Like, the way I would talk to a client if they called me and said, hey, you know what? I'm looking at getting in. I would like to buy my first investment property. And so I'm looking in, San Diego. Okay, perfect. Well, let's back up. What is your end game? Is your end goal to have passive income to be generated monthly to supplement your current income? Or are you wanting to go ahead and put some money into something and hope that value of the home goes up quite a bit faster than the other method, and you're okay not having the mortgage payment be fully covered every month, you can go ahead and supplement. Which of those is what you're looking to do, right? Completely different conversation, right? Now I'm actually serving my client and they'll say, hey, you know what? I don't really need the money per month. I want to take $150,000 of money I inherited from my grandpa and I want to put it into something and I want to turn it so that in 10 years when I retire, that's $250,000. And you know what? I'm an electrician. I make good money per month. I can cover $300, $400, $500 per month, right? Perfect, right? Or, hey, you know what? I have $150,000 from my grandpa. I want to put it in so that I can not have my wife work anymore and I need to generate some cash flow on it, right? How are you serving the client properly if you don't know what their end game and what their end goal is? So in upcoming ones I'm going to be doing, I'm going to be walking you guys through on my journey as I go through market by market on how to actually determine what an appreciation market is versus what an actual cash flow market is, because ideally we want a mixture of both. We want to minimize as much as possible the shortage between the rent and the mortgage while also getting a heavy appreciation, right? And we also, too, on the other side, we want it on a cash flow. We want to have a nice big cushion between the rent and the mortgage while we're also getting a little bit of appreciation, because there's some markets that have negative appreciation, believe it or not. So stay tuned, and like I said, don't ever prescribe the same investment strategies to all clients. Ask them what their end game is and then prescribe them the cash flow method or the appreciation method.